Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Herc Holdings Inc. Annual Report. Herc Holdings Inc. offers a wide range of equipment rental services to various industries worldwide. The company provides equipment rentals for aerial, earth-moving material handling, trucks and trailers, air compressors, compaction, and lighting purposes. In addition to equipment rentals, Herc Holdings also offers industry-specific solution-based services through its ProSolutions program, which includes power generation, climate control, remediation and restoration, pump, trench shoring, and studio and production equipment. The company's services extend beyond equipment rentals, with offerings such as repair, maintenance, equipment management, safety training, equipment re-rental, and on-site support. Herc Holdings also provides ancillary services like equipment transport, rental protection, cleaning, refueling, and labor. Furthermore, the company sells used equipment and contractor supplies, including construction consumables, tools, small equipment, and safety supplies. Herc Holdings serves a diverse range of customers across various industries, including non-residential and residential construction, specialty trade, restoration, remediation and environment, facility maintenance contractors, industrial manufacturing, infrastructure and government sectors, commercial facilities, education, healthcare, data centers, hospitality, retail, special event management, and more. The company's products are sold through its sales team, industry catalogs, participation in industry events, trade shows, and the internet. Unfortunately, I do not have access to the text you provided. However, I can still provide a general overview essay on what might cause a stock price to drop. The stock price of any publicly traded company can fluctuate due to various market and economic factors. One common reason for a decline in stock price is poor financial performance, such as declining revenue or profits. This can be caused by internal issues within the company, such as inefficient management or lack of innovation, or external factors like changes in consumer demand or increased competition. Another factor that can contribute to a drop in stock price is negative news and publicity surrounding the company. This can include scandals, product recalls, or other controversies that damage the company's reputation and erode investor confidence. Additionally, economic downturns or industry-wide trends can also negatively impact a company's stock price if it is heavily reliant on a particular market or sector. In some cases, a drop in stock price can be caused by changes in leadership or management, such as the departure of key executives or the appointment of new ones with different strategies. This can lead to uncertainty and volatility among investors, causing them to sell their shares and drive down the stock price. Finally, external market forces, such as interest rate changes or global economic trends, can also impact a company's stock price. For example, if interest rates rise, it can become more expensive for companies to borrow money, leading to decreased investment and lower stock prices. In conclusion, there are many potential reasons why the stock price of Hercules Holding Inc. may have dropped in the past year. Further research would be needed to determine the specific factors at play. Herc Holdings Inc. market capitalization of $5 billion is materially smaller than most of its industry peers of roughly $17 billion. Herc Holdings Inc. trades at a higher price-to-book ratio of 2.56 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation, signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The company exhibits a very high leverage profile, with liabilities accounting for 82% of total assets. This elevated debt level warrants heightened caution, as it may limit the company's financial flexibility and increase risk during economic stress. We have to further examine the industry and the nature of the business to determine if they justify the current valuation. Liabilities have grown faster than assets and equity, which is somewhat concerning. However, asset growth remains positive, suggesting management may be temporarily leveraging liabilities to fund expansion. Shareholder equity has expanded consistently over the past 5 years, with growth supported by rising operating income. This suggests the company is profitable and financially sustainable. The company has consistently reduced its share count, while revenue and equity have grown, indicating disciplined buybacks that enhance long-term per-share value. The income statement shows that the company have been growing its revenue annually, and the operating income have been increasing. This shows that the business model works and the business is expanding. The primary drivers of revenue growth or decline are multifaceted and influenced by various factors. On the growth side, key contributors include the acquisition of H&E Equipment Services, Inc., which added approximately 160 branches, as well as increased spending on industrial capital and maintenance. The contractor business segment has also experienced significant growth, accounting for 38% of revenue. Additionally, infrastructure and government spending have contributed to revenue growth, with this segment making up 18% of total revenue. Furthermore, the company's core equipment rental fleet has grown through investments in existing locations and expansion into new urban markets. The acquisition of Ate Mesa Sales has also been a significant driver of growth, bringing in $273 million in consideration, 135 employees, and 4 locations. However, increased volume of rentals has led to higher fuel costs and delivery expenses. On the other hand, revenue decline is attributed to several factors. The divestiture of Cinelease contributed significantly to the year-over-year decline in equipment rental revenue. Ongoing moderation in certain local markets where H&E's customer base was heavily concentrated has also had a negative impact on revenue. Acquisition disruption at H&E, particularly within the sales force, has further exacerbated the decline. Competitive pressures from existing and new competitors have led to decreased rental volumes, depressed prices, or increased costs, resulting in revenue decline. Decrease in orders or increase in order delays/cancellations due to economic conditions have also contributed to the decline. The company's financial performance has shown a significant improvement in its ability to generate cash from its core operations. As indicated by the operating cash flow of $1,085 million in 2025, it is clear that the company is now generating positive operating cash flow. This is a crucial milestone for any business, as it signifies that the company's revenue exceeds its expenses and investments, resulting in a surplus of cash available for future growth and development. The company's financial health has undergone significant changes in recent years. A review of the extracted summaries reveals that the debt level and interest expenses have both experienced notable increases. The total outstanding debt has risen from $4,069 million in 2024 to $8,021 million in 2025, representing a staggering increase of 96.6%. This substantial growth in debt is accompanied by a corresponding rise in interest expenses. The company's net interest expense jumped from $260 million in 2024 to $416 million in 2025, marking an impressive 60% increase. These changes indicate that the company has taken on more debt and is now paying significantly higher interest rates. This trend suggests that the company may be facing financial challenges or taking on increased risk to fuel growth. Management is optimistic about the company's future prospects, citing industry trends as a major driver of growth. The shift towards equipment rental in the North American construction industry will continue, and the company is well-positioned to capitalize on this trend. To maintain its market leadership position, management plans to grow through strategic transactions, including acquisitions. The acquisition of H&E Equipment Services, Inc. is expected to accelerate footprint growth, but integration may be more difficult than anticipated. Management is committed to delivering long-term sustainable value for shareholders through balanced capital deployment and maintaining sufficient liquidity. However, the company faces intense competition from suppliers and other rental companies that may lead to downward pricing or an inability to increase prices. To mitigate these risks, management has prioritized employee development through training and talent development opportunities, as well as prioritizing employee well-being with benefits such as comprehensive health insurance and volunteer paid time off. The company's financial flexibility has been improved through the new ABL credit facility, allowing for access to capital markets and ensuring liquidity. Overall, management is focused on maintaining market leadership while navigating industry trends and competition. By growing through strategic transactions, diversifying its customer base, and prioritizing employee development, the company aims to deliver long-term sustainable value for shareholders. The company has made significant moves in its financial strategy through acquisitions and divestitures. In terms of acquisitions, the most notable transaction was the purchase of H&E Equipment Services, Inc. on June 2, 2025, for a total consideration of $4.8 billion. This acquisition is mentioned in multiple pages of the financial report, indicating its importance to the company's growth strategy. The acquisition of H&E Equipment Services, Inc., is expected to bring significant benefits to the company, although specific details are not provided in the report. On the other hand, the company has also engaged in divestitures as part of its financial strategy. One notable example is the spin-off of its global vehicle rental business through a dividend to stockholders on June 30, 2016. This move resulted in the formation of New Hertz, a separate entity that operates independently from the parent company. Additionally, the report mentions assets held for sale, although no specific details are provided regarding these transactions. Overall, the company's acquisitions and divestitures reflect its efforts to optimize its financial performance and adapt to changing market conditions. The company has demonstrated its commitment to returning value to shareholders through both dividend payments and share buybacks. In terms of dividends, the company declared a quarterly dividend of $0.70 per share in December 2025, marking the beginning of a consistent payment schedule throughout the year. This indicates that the company is prioritizing shareholder returns by providing regular cash distributions. On the other hand, the company has also been actively buying back shares through its $1 billion share repurchase program initiated in March 2014. As of December 2025, there was still $161 million remaining from this program, suggesting that the company is committed to reducing its outstanding share count over time. Overall, these actions demonstrate a clear focus on shareholder value creation and return on investment, which should be viewed positively by investors. There are concerns about inventory buildup or supply chain disruption, particularly in relation to potential disruptions due to suppliers' unavailability and delays. This is highlighted on page 12 as a risk factor that could impact operations. Supply chain attacks and large-scale events affecting multiple customers also pose significant risks, as noted on page 14. Furthermore, the supply of used equipment relative to demand is another area of concern, with potential implications for inventory levels and supply chain stability. The possibility of future supply chain disruptions is also mentioned on page 29, underscoring the need for proactive planning and mitigation strategies to minimize the impact of such events. Overall, while there are concerns about inventory buildup or supply chain disruption, they appear to be more focused on potential disruptions rather than actual inventory accumulation. That concludes the financial summary for Herc Holdings Inc. Feel free to comment below, and I will be happy to answer them when possible.